Okay, cool. So probably I'll just start from this slide. So it's pretty interesting. There are multiple lenses through which you can actually see auto ancillary industry, and there is no right or wrong. You can choose any lens, but I think the key point over here is which lens you select depends on your investment framework, according to me. So that's why next slide, I want to briefly touch base on my investment framework, and then probably which will tell us that, okay, why I'm selecting this bottom-up lens. And then probably, yeah, we can speak about these other lenses as well. So this is my investment framework in very, very high level, at very high level. I've written something around this in my value picker, on my value picker thread also. So the first bit in my investment framework I consider is how comfortable I am with risk. I don't go on growth drivers or industry tailwinds at all. The first point I see is how comfortable I am with the industry level and the company level risk. And in that, if the industry has sort of seen multiple cycles, taking judgments on the risk become a little easier. And similarly, if the company has some sort of track record, then again, how company has done when the industry sort of headwinds were there. So it becomes easier to judge the company level risk. So once I'm comfortable with the risk, the next thing is what I'll see, the bottom-up analysis of business and the management. So we can expand this and probably talk in the separate session. Okay, what's the bottom-up business and management analysis within my investment framework? But I think the key bit to note over here is what I would like to see is if the business profile or the risk profile of the business is improving across the cycles. Yeah. So is the risk profile of the business sort of remaining stagnant, or it is improving throughout the cycle? And so I personally have a tendency to sort of build larger allocations, and I am willing to hold through the multiple cycles. So that's why the lens which I have chosen to look across or look through at auto ancillary industry is, for the lack of word, I call it as a bottom-up lens, and we'll speak in detail in next few slides. How do I see auto ancillary industry through this lens? But as I said, there is no right or wrong. You can actually choose any lens which you want, and your eventual outcome will depend on how good your judgment is across on the lens which you are choosing. So just industry landscape, next two slide talks about industry landscape. So this is very simple slide. So what are the revenue drivers for any auto ancillary player? So they can sort of increase their market share in the existing portfolio. So that is through the new account, winning new account, new logos, or they can penetrate the existing account or sort of increase the wallet share with the existing client. They can launch new products. So that can be for the EV, that can be for BS6 or BS4 to BS6 sort of transition. That can be under a category called premiumization, or for the content per vehicle improvement, or as a PLI, import substitution. So they can also increase the revenue improve the revenue profile by sort of expanding the geographies. Now that can be done through exports, or that can be sort of done by improving the global footprints. I mean, don't have to be export. You can sort of have your global supply chain where you have plants at multiple locations from where you will supply your clients. And last but not least, how you can improve your revenue is by getting into new segments. So anything outside auto, it's practice to term them as the non-auto segments. It can be agriculture, it can be industrials, or it can be any industry outside auto. It can be, the new segment can be in aftermarket, in India aftermarket, global aftermarket, which is kind of a B2C business. Or there are the consumer sector where some of the auto ancillary player has exposure to. So these are, to sum it up, so if any auto ancillary player has to sort of increase revenue, it can done either through increasing market share, it can be done through launching new products, it can be done expanding geographies, or it can be done through entering in the new segments. Now, I hope I am not disconnected, yeah?
Yeah, you're here.
Okay, yeah, okay. Yeah, so next bit is understanding the strength and weakness of the auto ancillary business model. I think one of the key strengths of auto ancillary business is this business has very high entry barrier. In my recent readings, I don't remember where a lot of established auto ancillary player has lost market share from someone else. So the reason for that is it has a very high, not switching cost, but entire the switching process from one vendor to other. It's very time consuming. So it at least takes 2 to 3 years to switch from a vendor to another. And that's why I believe auto ancillary business has very high entry barriers. Now, the weakness are obvious. The first weakness is it doesn't have this business doesn't have any pricing power. So the prices are fixed by OEs. And if there are input cost pressures like what we had in 2020, from late 2021 to now, so there is a hard bargain which auto ancillary player has to do with the OEs. And usually in the India business, there is a pass through, but global business, there is hardly any pass through. So, and when the price increases, auto ancillary players go to OE, begging for the price increase. And when the price decreases, OE players come back and say, hey, price have decreased. You're going to reduce your price for, the product you're supplying to me. So there is absolutely no pricing power in this business. And the second sort of weakness of the auto ancillary business, and I think this is one of the most sort of turn off for a lot of investors, is the cyclical nature of the industry.
Omkar, can I quickly interrupt you with a quick question on something that you
Sure, yeah.
Could you explain why it takes 3 years for a company, let's say TVS or Hero, to switch partners, even in a like-for-like product?
When you say like-to-like product, as in?
No, so I mean, if they're looking for different suppliers for headlamps, for example, why does it take 3 years to switch between OEM partners? Could you give some clarity on the stickiness? Like what are the reasons towards that?
Okay, so let's take example of headlamp, which you said. Okay, so usually what happens, typically there are 2 to 3 vendors for a headlamp. And let's say for a Maruti, for WagonR, entire WagonR will go under, let's say, Lumax. Yeah. And for a Brezza, entire Brezza sort of model will go to Minda, for example. Yeah. Now, for the conception of project, let's say when the Maruti decides that okay, they are going to launch Brezza or WagonR, till actual launch, that itself takes 2 to 3 years. Okay, so once it, I mean, so the product development takes probably 2 years, and then your product schedule starts. So if as a supplier, if I'm supplying, let's say to Maruti for the WagonR, then switching.
Omkar, can I jump in? Just
Yeah.
just a second. Shinmay, it's very simple, right? Vendor selection happens in most of the companies. What they do is they have three key parameters when they're doing vendor shortlist. One is quality, infrastructure, and third and foremost is, will they have contractual obligation? Is it a short or long-term contractual obligation? Okay, so the third bit is very important, because when an OEM player is having an interaction with let's say Maruti is having an interaction with its auto-ancillary partner, they try to work closely with their engineering team to actually come up with the product dimensions and also in the production floor to sustain the quality output. I am sure you must have heard about Kaizen, right? So they are trying to minimize the quality issues that the vendor can provide. So for that cycle to complete and onboard a vendor, as Omkar said, it will take 2 to 3 years. Right?
Okay, so it's linked to the product cycle of new launches and that. Okay.
Yes, and that's why if you see, I'm sure you would have gone to an after-sale market saying, "Oh, I broke my headlamps." Why is Lumex more expensive than a local player? Because the rate of defect in a local player is far higher, and that cannot be the case when you're giving a new car when they give you guarantee of 90 days or 180 days, saying then that becomes a service error for Maruti or TVS and so on. And this is the key reason why that sensitivity of changing vendor is very hard once it's established, right?
Okay, cheers.
Right. Okay. Thanks, Vijay. Yeah. And so next bit is, once you know the weakness, let's understand what are the levers available to sort of address those weaknesses. So for the pricing power bit, one of the lever which I think any manufacturing unit can do is prepare your business model such a way that it's kind of sponge. You are ready to absorb the cost so that my fluctuations in margins are minimal. And that's where I think the Kaizens and Six Sigma probably also come into play. And the second bit, or the second lever to improve margins or maintain margins, is sort of develop and launch higher margin products. But it obviously has the higher gestation, as in you cannot sort of decide today that it cannot be that, okay, I decided today that I want to launch higher margin product and I launch it next year. It needs a technology development, product development, and then launch. So at least you need to start preparing 4 or 5 years in advance. And so these are the levers which are available to attack or sort of counter the pricing power weakness. And to address the cyclical nature of the industry, what are the levers? So one is to sort of in your revenue profile, how much is your non-auto aftermarket share of business, which is kind of less cyclical than OE business or auto business. Aftermarket especially is more secular. And also how your revenue profile is sort of spread across geographies. Also that also, so if someone's revenue profile is spread across geographies compared to someone which is India focused, the India focused company will suffer most when there is a downturn in India. So you can sort of try to create sort of diverse revenue profile, as diverse as you can, to minimize the impact of cycles in specific country. The second lever available, which I think Sona Comstar did in 2021, is you keep on gaining market share so that you increase or you sort of grow much ahead of industry. So I think 2021 Sona Comstar's revenue was fantastic. I guess I don't remember the exact number, but compared to market downturn, we had their revenue profile was pretty robust. So in the next slide, and this is pretty interesting slide, and let's see one by one, very briefly, how each of these players are playing their game. And this is my interpretation. It can be sort of it's a judgment, so it may not be right. But so let's see Motherson Sumi. So Motherson Sumi had something called a 5-year plan. So they sort of, I think they are now on the 4th 5-year plan. So in fourth or fifth, which I don't remember, but in the first 2 5-year plan, they did it very nicely. So can you see the Motherson's presentation?
Yes, we can.
Yeah. Okay. Yeah. So yeah, and the idea they try to sell investors is that they are always doing acquisitions at the behest of customer. So customer goes to them. So according to what they are telling us is, the customer goes to them saying to Motherson Sumi saying, okay, one of the vendor is weak, please go and acquire them and start selling. So that's the kind of game they are playing. So it's always global expansion. So they have done fantastically in first 2 sort of 5 years, or even so the execution wise and even M&A track record has been fantastic for Motherson. But what it has done, so if you see that company is, I think 40 years, I think at its peak it was some 60,000 crore market cap company. But if I have to sort of assess the business profile from the lens of from the lens of risk, so it has not improved at all according to me, because they kept focusing on these acquisitions, and so they never got chance to sort of diverse their revenue profiles outside OE, and that's where their revenue profile always remained cyclical, and that's why you see in last cycle they suffered a lot. So now I think market cap has gone back to.
Omkar, can you repeat that last phrase, because I might have misunderstood it. Can you repeat that sentence altogether after the acquisition piece you mentioned?
So what I'm saying is, so the game they play is so the acquisitions, and which acquisitions? The acquisitions at the behest of customers. That means customers come to them and tell them, can you please acquire this sort of vendors because they are sort of financially stressed, etc., and or the quality is sort of degraded. So can you acquire and sort of improve the profile, because they expect Motherson to improve the profile of that vendor. So that's why, if you see, so they did a lot of acquisitions, but they did it very nicely. Their execution wise, if you ask me, they are 5-star, probably 4-star. But all these acquisitions across, since they were doing at the behest of customers and they are not deciding product by themselves, their revenue profile always remain OE heavy. Yeah, because they are sort of acquiring company requested by a OE, and that's why.
Yeah, I have a question here.
Okay.
Now that they are acquiring companies to benefit the customers' needs,
Mhm.
has the pricing power for Motherson has improved or not? That's the question.
Right. So if you, I mean, according to me, there is no pricing power in business. I don't think, there is, and that is reflected from their sort of margin profile also in the downturns. So there is, I can, so to some extent, okay, they can increase or they may have some sort of upper hand because they have done acquisitions on the behest of customers. But I don't think that sort of compensates for the price pressures, because at least so that numbers doesn't say so.
No, Asir, if I'm running one of these business units, right, just as a business person, pure business person, right? If a customer
Mm-hmm.
comes to me and says, Vijay, there's another company which is one of my vendor. They have quality issues. They're not able to deliver on time. I know you will be able to deliver on time. Can you acquire it? Okay.
Mm-hmm.
What I would say is, will you partly fund that acquisition? The question is yes or no. There's two types of funding. One is either cash infusion or working capital infusion. What is working capital infusion means? Instead of 90-day payment term, they give cash upfront, yeah, or advance payments or something. That's the two modes of financing the deal. Okay, so I go acquire, I improve efficiency. That means I'm providing two critical components to that OEM. So my pricing should improve, right? And I will be in a better negotiation for two things. One is pricing, second is payment terms. If that has not improved, then something is happening with Motherson Sumi as a company. You get my point, right?
Yeah. So exactly. So I mean, my sort of doubt or issue is this can be a narrative, right? I mean, acquisition on the behest of customer. If something doesn't look nice to me, if something doesn't fit within my sort of let's say whatever return metrics,
Or portfolio itself, right? Product
portfolio,
offering.
then how, I mean, whatever customer says, I don't care. I mean, so this looks narrative to me, to be honest, but that's my personal opinion.
I would just like to chime in very quickly here. If you are a B2B business, and if the customer wants you to do something and you're dependent on that guy, and you're getting a good deal. So one thing which was missed in this discussion was also Motherson Sumi acquires very cheap assets. So they don't pay up. And
Right.
mostly auto ancillary is an efficiency business where you try to become like, that's why you go into all this Six Sigma and other shop floor strategies where you try to bring out efficiencies. So if you can bring out efficiencies at scale, that's a very, very big competitive advantage. And that's also one reason why we have one auto ancillary company doing more than 1,000 crores back. Otherwise, this sector, it's very, very hard to grow the profit pool, because at the end, you are dependent on the OEMs unless you build a very, very big aftermarket. And for most of these companies, aftermarket is generally not beyond 20%. You can find exceptions like battery companies like Amara Raja, those kinds of folks who are able to build 50% plus aftermarket. But it's very hard if you're making a car doesn't break down that often in that aspect. So there are not so many parts that you replace in a car. So we have to also give credence to the valuations at which acquisitions are done, and why the acquisitions were done. Sometimes just buying very cheap things can also work out, even if it is not like a very high class thing, the technology you're acquiring or the kind of company you're acquiring.
I mean, I partly agree on this, and if I'm looking at it from a product lens, right? Just imagine Motherson providing 30% of components of a fully finished car. It's just one vendor to deal with for the car manufacturer or automobile company, right? Which increases efficiency for them also. So yeah, it makes sense, but it's worth. I don't know Motherson Sumi's debt position. How are they? raising capital to acquire companies, but it's worth looking into it. But let's see.
Yeah. So yeah, and I think to add to the point what Harsh was making, right, about aftermarket business. So it so that I think it starts with the product you're selecting. So when you are selecting a product, what considerations you are giving, I think it starts with that. So if Motherson sort of wants to be in the sort of products or the parts which are very critical to OE, and that's their starting point. I mean, aftermarket business will take a backseat. I mean, their focus won't be on aftermarket, and that's why you will see Motherson's aftermarket business is almost, there is no aftermarket business for Motherson. And even non-auto, this recently in this 5-year plan, they started sort of giving focus to any business outside auto. So and that's in fact that's my sort of key point or key thesis for Suprajit, which we'll talk later. But yeah, so again, the point to highlight is that with all these acquisitions, with all this good scalability, in my opinion, Motherson's risk profile has not changed in last 10 years. And the reason I want to give is that 10 years back or 5 years back, the revenue or the susceptibility to sort of cyclical downturn, what Motherson had, I think it's same, and that's what we saw in this cyclical downturn. They suffered kind of the same way they probably would have in earlier cycles. So that's my that's how I want to look Motherson. So next is Minda Industries. So Minda, probably I will call it Indian Motherson. Yeah. So what Motherson sort of did across the globe, Minda did within India. So they launched multiple products. I mean, they created good wealth from in 2017 to 19 cycle, and I think they are present in almost all the product segment. But so their business is, you can see the global business share is very less, 15%, and they have 12% aftermarket. So they have Minda brand, and then they have negligible non-auto business. So the strategy or their sort of Minda, I think I have not opened, but that's fine. So their play is, okay, I want to increase my content per vehicle. So that's the game they play. Next is very interesting, Sona Comstar. I think Sona Comstar brought a completely different narrative. So till the Sona Comstar, most of the sort of strategy or the narrative was how I'm increasing the content per vehicle. And I think Sona Comstar completely changed the game. So I'm just opening the Sona's presentation. Yeah, so Sona Comstar actually consider itself as an R&D company. They have very technologically high profile products. You can see their legacy products are differential gears and starter motors, and the blue sort of circle is their current product portfolio, which is again pretty high tech. And then there are future products. So Sona's strategy is so they want to be R&D company, and they have excellent margins, but high margin profile usually come with high capex. So if you see overall ROE levels, especially recent 3 years, they are still around 20%. So high margin may not, definitely, so Sona with Comstar with 25 or 26% margin they have. And I think some other player which has, let's say, 12-13% margin, they can still generate similar ROEs, which is 20% odd. I think because the amount of investment goes in setting up plans for these products. So yeah, so I think Sona Comstar, what it did in 2021 was brilliant. So their focus is on EV parts, sort of connected electronics, etc., etc. So they are playing the game of sort of technology, technology company. Next is Lumax. So Lumax is in the lighting. I mean, India business lighting, straightforward. What they are betting on is the LED migration of lamps from current halogen lamp to LED lamp. Next is Endurance. Endurance is also very well managed company, consistent margins. So they have a global business, which is 24% of their revenue. The issue with Endurance is that their global businesses, I don't see as an integrated sort of business from the India business, and the global business is not integrated. So the global business is like a side operation they do, and then they have a good Indian portfolio, and whatever new products they are launching is for their India business. So if you have two separate product baskets, one for global operations and one for India, so there is this sort of conflict, I think one will witness, or management sort of has to take, at which business they have to grow, because the capex is going to be limited. The next is Sandhar. I think Sandhar has done a lot of JVs, lot of capex, and a lot of people see it as a cyclical upturn game. So they have a lot of JVs which are currently loss making, but the investment thesis over there is that as and when the industry comes back, as in the revenue comes back, so Sandhar will sort of start improving its business metrics. Next is RACL. I think RACL Gear Tech is a very interesting company. It has done in last 3 years, it has sort of done exceptionally well as part of their the growth and improving margins. So one of the things which which I don't like, or I've been mindful about RACL Gear Tech, is that it's the large working capital cycle it has, and the higher capex requirement for its products. So that's why they are not really able to generate the cash flows. I mean, if you see the current year's cash flows, they are gone back to 3 years level. Next is SGS. SGS Enterprises is new kid on the block. I think Chinmaya has written about that company on the Value Picker thread. But again, so they are in the aesthetic segment. They have sort of diversified their so they have multiple products within aesthetic segment, and they have also the consumer segment, which is sort of non-cyclical, you can call it.
Hey, Omkar, I have a question. During your research, do you know which components have a great aftermarket? I mean, I see that Amar Raj, basically batteries, but in Suprajit, if we are going deep into this company, where do we generate that aftermarket revenue? What are the product lines that are generating, right?
Right. Yeah. So I'll probably jump on to Suprajit. Yeah. So usually, now that's my sort of reading says, but probably may not be perfect. So the aftermarket business comes from the consumable parts, right? And if my product is high-tech product, like in case of Sona Comstar, they are pretty much high technology oriented products, there won't be any aftermarket for those business. Yeah, because you will, let's say, hardly change your starter motor. I mean, or the inverters or differential gears, or you will hardly change that. The aftermarket will come in something they call it class B product. So there is a class A and class B. So class B is something, so this classing depends on the overall cost of that product as compared
give me an example. If you have one example, let's say light bulbs or whatever, right?
Correct.
The reason is OEMs let's assume that Suprajit is an OEM to Maruti or whatever it is. The traditional automotive companies will squeeze out the efficiency or squeeze out the margins out of Suprajit or any auto-ancillary piece. I've done a few case studies on some companies in the US. Just wanted to understand, because the best performing assets would be the ones that have they're not losing money on when they sell to the automotive companies, but which has a strong aftermarket for the products that they go in, these things, so that whatever, even they is just like Gillette razor blades, right? They give you the product at a loss or more or less at cost, but they make the profit mostly in the aftermarket, right? What I'm trying to assess is, does Suprajit has that optionality of because Amar Raj is a clear example for that, right? Let's be honest.
So that's an interesting. So now actually let's kind of not deep dive, but let's start with the Suprajit. So, and that's when Suprajit decides to select a product, it actually considers all these points. So the starting point itself, they have considered, okay, does this product outside OE, does this product has non-auto business? Does this product has global market? Does this product has aftermarket? And does this product has export opportunities? So when I'm selecting a product, at that time only I'm deciding all these factors. So Suprajit just has two products. One is cable and halogen lamp. And so they started their operations in 1985, and from 1985 till 2016, there was just one product, which is cable. And then in 2016, they acquired halogen lamp business from a company called Phoenix Lamps. But when they select product, their criteria is this: I want to add a product in my portfolio, which has non-auto business, which has global market, which has aftermarket, and which has export opportunities. Now, if you think this, and if you compare to now, go back to Motherson Sumi, so when Motherson decides a product, it thinks about OE, and which is right. I'm not saying it is right or it is wrong, but so Motherson thinks what OE wants, or what OE is they are telling them, and then sort of how do I scale that product. But when Suprajit decides the product, they want to add only those products which has all these segments, and then they select the product. Does that answer your question? Sorry. And usually these products are, so for example, cable in two-wheelers, total cost of mechanical cable, I will talk about what cable is, but the cost is not more than 700 rupees out of, let's say, 60,000, 70,000 vehicles. If you see the lamp, the cost of lamp is 100 rupees max. So if you see these products are, we call it class B, or the low cost products. And I think that's where you have higher chance of aftermarket business. It doesn't mean that all low cost products will have higher chance of being aftermarket, but I think the point I'm trying to make is, when you are selecting a product for your company as part of the portfolio, you are giving consideration at that point, or let's say you build, let's say, portfolio which is OE specific or OE centric, and then one fine day you come and you decide, okay, now I want to build aftermarket portfolio. Now let's see how I can build that. So how you are playing that game. is different. So, for example, if you see Minda, yeah, and they have a lot of products in their kitty which they are focusing on India, and but not all products are aftermarket specific. So that's why what they are doing, some of the products they are launching only for aftermarket. So for example, Minda also has a lamp, as in the head bulb in the aftermarket, but they are not selling head bulb to OE. Yeah. So rather than, in my opinion, rather than thinking how a specific part or what are the parts which has sort of aftermarket, I think it's important to think how company is adding new product in the portfolio. So when they are adding a new product in the portfolio, what's their strategy? Is their strategy like Sona Comstar, go for EV play for sort of EV play, or is their strategy like Motherson Sumi, where sort of what customer is telling them, acquire those vendors? Is their strategy like Minda, where go for content per vehicle? Or is their strategy like Suprajit, for example, where I'm selecting a product at that time only, I'm giving all these due considerations? Any questions?
No, I have one small feedback on this is, uh, so this is also what a management tries to do. The management's job is to try to create like a big profit pool at the end. Uh, so having, so I have a very fundamental basic question for you at this point. Uh, so if you have cyclical cash flows, but in the over a cycle you make more money versus if you have predictable cash flows and over a cycle, let's say you make less money, is it better to go with the cyclical cash flows or with the cyclical ones?
Very, very interesting question. And to be honest, I haven't thought like that.
Okay, I asked this because while you were presenting, I was looking at the PAT of all the companies in auto-ancs. And I can just share, not the screen, just the results. Like Exide, it's a one-off for Exide because they sold their uh, business. Insurance business. But Bosch has 1,200 crores. And Motherson Sumi, like if we combine both their entities, so Motherson Sumi, the new one, the Motherson wiring one, which was newly listed, it's 17 or 1,800 crores. So whatever they have done, even without aftermarket, they have created the highest cash flow pool in all the listed universe. Whereas a lot of other companies have kind of got stuck at around 200 crores PAT. Although, like for example, Suprajit, they have had very predictable cash flows with predictable margins, but in terms of absolute size of cash flows, they have not managed. Maybe even if a business is cyclical, catering to OEMs obviously would be more cyclical than aftermarket. But if you can penetrate a lot of OEMs, doesn't that give you a bigger canvas to paint rather than trying to specialize in a niche where you cannot create a 2,000 crores profit pool? Is kind of my where I'm getting to this from.
Okay. Yeah, I think it's an interesting viewpoint. And to be honest, my thesis, the core of my thesis is how to create the predictable cash flows. And if your market size is large, eventually your profit pools will be similar to the, let's say, likes of Motherson or Bosch. Yeah. So I mean, it's a fair question, Harsh, and I haven't thought. Probably I'll think over it. That if being cyclical or the cyclical cash flow is giving me larger profit pool over the cycles versus predictable cash flow, which is giving me limited profit pool, which one is better?
Just 2 cents from my side, Harsh. That's a good question. If I was a business manager, what I will do is I'll take the cyclical cash flows because I know it'll be peak during a specific cycle, and take that, and during a down cycle go acquire cheaper assets or a product lines to stabilize over a period of time.
This is exactly what you described as Motherson Sumi strategy. They take cash
Exactly.
flows at the peak and they buy at the bottom. And that's why they've been able to build 2,000 crores of profit.
Exactly. We need to start thinking as business owners rather than an investor.
True.
This is where the competitive alpha will come in.
Yeah. Nice. So, like how Motherson does it, okay, so there is pretty interesting way how Suprajit buys companies cheaply. So Suprajit recently acquired a company which is from a company called Kongsberg Engineering in Norway, and for I think 300 odd crore, or I don't remember exact figure, but 300 odd crore. They acquired company with a 700 crore revenue profile with a 10 to 12% EBITDA. So that's pretty lucrative on EV EBITDA front. And so this is, I think, so the second and third point as part of this investment. This is, so once they select a product, which is non-fancy product, to be honest, like a mechanical cable, which is very, very dull product if you ask me. And so they tries to be the most efficient player in that product. Yeah. And for that particular product, they are sort of their margins are some 16-17%, where Hilux, which is a sort of global leader, their margin is 7%, and Suprajit is number 2, and still their margin is 16 or 17%. So once you have a good sort of financial matrices in these set of products, next step what they do is they go out and buy competitor cheaply. So this they have done, so they have also, like Motherson, Suprajit is very active in M&A market. And as I said, recently they acquired a company which was number 2 in mechanical cable business, and they acquired it for 300 crores, and that had 750 crores of revenue potential, which will start reflecting in P&L from Q1 with a 10 to 12% EBITDA. So that's very lucrative on EV EBITDA front. So because in these kind of products, very few companies, so even in lamps, so they have 2 products. One is mechanical cable, and second is the headlamp bulb. Yeah. So I mean, we'll I think that's a separate topic where the LED is pose a challenge to sort of to a terminal value of that business, but they have the globally best margins in that business. So using that and with some patience, they sort of try to acquire their competitor cheaply. So that's what I feel. Suprajit, with its product portfolio, they are able to sort of buy competitor cheaply because they are having a superior margin profiles or financial metrics in their own product portfolio. So this was I was taking, but point well taken, Harsh. I mean, so my core thesis is what you see from 2001 to 2, where 96 or 97% business was on 2-wheelers. When you come to 2000 next year, at the end of next year, only 25% business will be in 2-wheeler, and rest will 30% will be automotive. 24% will be non-automotive, and 21% will be aftermarket. So 45% of the revenue mix is kind of non-cyclical. So actually that was my core thesis, that the cycle, if you see how company has transformed itself from 2001 or through cycles, I think they are lesser prone to the cyclical downturns than a lot of other companies. Any questions here?
Yeah, I have a question like on the capital allocation bit. Like, do you think so? If you look at the ROCE or let's say the ROE of the company over time, it has been coming down and quite significantly. I think the 2015-16 deal of Westcon, and I think they acquired two companies there. And then they did another one, I think in 2018-19. The ROCEs have come down over time. Not ROCEs, but let's say ROEs have come down over time. Do you think like incrementally where they're allocating capital, like this Kongsberg looks to be quite good just because they have acquired in their core competence. So it's kind of the best kind of acquisition. If you want to do an acquisition, bought cheaply, bought in a place where you already know the space very well, and it gives you access to adjacency. So I think this acquisition makes much more strategic sense. But like the Phoenix Lamp acquisition and the other one, I think Westcon, yeah. Do you think it was like now we have 6 years of data? Do you think those acquisitions were good?
Yeah, I think it's pretty. And to be honest, this is a good question. And it also, I was also thinking on the similar lines for the Eris. You know, we had some time back, we had same discussion on Eris, where we discuss, okay, 5 years down the line, what acquisitions they have made, does it make sense? You know, so yeah, point well taken. And so the reason, I'll tell you my thinking and some of the reasoning given by management. So they acquired a company called CTP Gills in, I think, 2006 or something like that. Yeah, 2006. Yeah. And so that company was, I think that company was based in UK. It has manufacturing unit in UK. And once they acquired that company, what they did was they kept only front end in UK. That means maybe sales team, and entire manufacturing unit they shifted back in India. Okay. Now, so this acquisition, it took around 10 years to show the results. And that's what they keep alluding to, that and now it is one of the most profitable sort of segment in their entire business. If you see the export, it has some abnormally high margins. They have some 23-24% margins last year in the export. And I think even ROE wise, their export business is one of the best ROEs in the entire the business segments. So it's a fair call. I mean, so even I was questioning myself when I was going through that period, that okay, the acquisition they have done, Phoenix Lamps, which is in the bulb, and the Westcon, which is non-auto, it is not sort of giving the desired results, and how much leeway or how much rope we should give it to management so that they start sort of delivering. So Westcon started delivering from this year. So they had to change management. They changed their CEO over there and they changed the strategy. So it started up from 2016. I think 2000 last year was kind of the they started showing the results. Phoenix, it's still under the hood. It is not showing the results. And I believe they bought it at such a ridiculously low price. It saves them somehow. But from the capital allocation perspective, yes, I would say so. It's pretty interesting. How do you see the capital allocation decision? I mean, when you are acquiring, so you think, okay, if ROE is coming good, so I don't know the standalone ROE of Phoenix at this stage, but should we see the growth? I mean, let's say if I acquire a company and first 5 years I have a good ROE but no growth, and then I have a growth, is it better? Or I should have good ROEs and the growth from, let's say, year 2 and 3 onwards. But yeah, so it's a conflict, and I understand. So somewhere that bias can come in the decision making. So I tend to give them a longer time for them to prove themselves in the acquisition, and that's why so that's
just a very quick comment. Like, it's very easy to judge like if the current acquisition was better than the current business, because if it was, then the ROE, it should be ROE accretive, which is generally never the case with an acquisition. You can never have acquired that one at those. That would be a discount to book value that you have to acquire at. And if you're acquiring at that multiple, then probably there's something wrong with the asset. So for me, like how I try to judge it is how ROE was like for that business unit, and if they are able to pay off that acquisition. And so what is the time frame in which they are able to pay it off? If it's anything between 3 to 5 years, I generally consider it to be a very, very good acquisition. Others may also share experience, but anything below 5 years is considered quite good. If from that cash flow, you just pay it off.
Yeah, exactly. And that's what they keep referring to. Their payoff period was, I think, so they acquired Phoenix for some 120 crores, first 60% tranche, and then they sort of merged. So overall, I think acquisition costed them around 150 to 180 crores. Yeah. And their average EBITDA was 40 crores in Phoenix.
So it was not a bad acquisition.
Yeah.
Assuming their terminal value is still there, then you have to pay it off in 5 years.
Yeah. So that's so that's what they keep alluding to, that their return or their payback was really good, because this is a cash generating business which generates around 30 to 40 crores of cash every year. And overall size of the deal was around 150 to 180 crores.
Yeah, thanks for that clarification.
Yeah, so probably, I'll just view next 2 slides and then I'll pause and I'll end. So, okay, again, reiterating the key thesis is the way they select product, according to me, was my key thesis. So when they select product, at that time only they are giving considerations to all these factors, and that only that product they are adding. So they get sort of a large market size for all these products. So automotive cable, globally, it's like a 3 to 4 billion USD industry. And then non-auto cable, there is no, I tried to find some numbers, but I couldn't find a number, but presumably it's at least at the similar size. So industry, so non-auto, even for example, aviation or aeroplane, they also use these cables. So these cables are, okay, well, maybe I didn't talk about what these cables do, and probably I'll spend 1 minute on that. So the cable, actually, mechanical cable transforms mechanical force from one end to other end. So for example, when you open a latch of or when you open a door, when you pull the sort of latch, so that has a cable attached to it, which transforms your sort of pull force to the end of that, transmit that force to the end of the cable, and it opens the sort of, there is assembly attached to it, and it opens the lock. So similarly, when you press the button of the power window, that force, that it has a cable attached to it, and then that it has assembly which sort of converts the pull or the push which you have given to the end action, which is opening or closing the window. So I think overall the market size for this product, according to me, is very large. So quickly, maybe I'll end in next 5 minutes. So since M&A is like a key growth driver for this company, it's pretty interesting how they have done and how patient they were in while acquiring the companies. So there were two stories. So one is so they acquired a company called Phoenix Lamps, which is in halogen bulb business, on 2016. The same company was on the block in 2010, and Philips gave offer for the same company at 180 rupees a share. And so the P fund, which is Actis, which was sort of owner of this company, rejected that offer because in 2006 they acquired or they came in at the similar price range. And sort of Ajit Rai was was a sort of promoter. He walked away from that deal with 180 a share. They are very value conscious in their buying and selling. So in 2016, when they bought Phoenix Lamps, they paid 80 rupees a share. And so I think that that talks much about the payback period. That's why they managed to get a very good payback period. Similarly, the latest acquisition they did in 2020, in 2021 they announced that acquisition in October 2021, and from Q1 onwards, that will start reflecting in P&L, which is Kongsberg. So the same company or the same unit was on the block in 2016. So they walked away because of the price what they wanted. They were not getting. They walked away from that sort of deal, and again that deal did not go through. Somehow they got same deal in 2021 with the price they want. So it's very interesting, the patience they show in their acquisitions, and that's why they managed to get the better sort of prices. So they also have a very lean corporate structure. So they focus pretty much on trying to keep the simplified nature of the company, and so in one of their interviews, the CEO sort of highlighted the reason for keeping the simplified structure, because it will be very easy for investors to know where their money is going, and that's why even their corporate structure overall, because they have a simplified entity or corporate entity structure, their management structure is also pretty lean. Which is again interesting, and in their corporate presentation they highlight this. I've seen very few companies sort of highlighting this aspect in their investor presentations. And also the third very interesting point, the succession planning is very detailed, and they have done it pretty interestingly. So I mean, we actually can have a separate call to discuss this, but to give some sort of idea about how they have gone about doing succession planning, is that first of all, they have a professional group CEO, which is outside the promoter family, and the next generation is being asked to report to that group CEO, and so then the family trust is so the ownership of the company is through the family trust, which is the Suprajit family trust, instead of having the individual ownership. So it is pretty interesting to see how they have done the succession planning. So probably we can have a talk later, but and last but not least, the risks. So I think, according to me, the strength they have in their product selection, which is, they select product which has all those factors, may invite the risk also, because the product selection tends to be the technically inferior products, and that's why there can be higher chance that those products get replaced with something superior technology. So for example, you have drum brakes, which are, currently the drum brakes are being replaced with disc brakes. Then in the electric vehicle, you don't need a throttle, so there is no mechanical throttle needed. That is being replaced with the electric throttle. So I feel somehow, because the selection, revolves around all these factors, and that's why they tend to select technically sort of inferior products. There is some there are some chances, or there are some risks around that, which um, um, because of the technology, some risk might play out. And as Harsh was saying, M&A execution and how do they complete the integration is another risk. As 2016, the acquisition done on 2016, after the 6 years, it is still kind of under the hood. So there is always a chance in future where that acquisition may not give results in the time period sort of which is expected. So I think these are the key risks. I think I'll stop here. If any questions, I'm happy to take. And yeah, that's it from my side.
Yeah, I really want to thank you for the presentation. It was super useful, especially capturing all the companies and like your table where you showed the contribution of different companies. If you can do it for all the companies, that will be so value additive, just to see where everyone is placed. Yeah, this slide. So thanks for this. And I think you might know, like Suprajit has been one of my favorite stocks. So I did not want to badmouth it or anything. But also one thing which I found with Suprajit over time was their core business is something which gives them a lot of cash flow. So the cable business, which is like the basic bread and butter for them, it produces very, very high ROCEs. And you can see this also in Motherson's wiring harness business. So Motherson also makes wiring harness. And I even have a thought process behind it, why this might be the case. Mostly auto OEMs do not make 25-30% ROCEs, like most auto OEMs. Sorry, most auto banks do not make those kinds of ROCEs. The only ones which make it are the ones who are making cables of wiring harness. And that's mostly because it's a very human intensive work. Like it requires a lot of people on the shop floor. And if you build your facilities in places which are kind of in the rural part, or it's a bit away from the metros, and if you have a reasonable pay scale for them, you can actually end up making very high ROCE. So, and Suprajit uses this cash flow to then try to diversify its business line. But over time, what I've also realized is the acquisitions have not been bad, but it's also not as good as their core business. So that's one thing where they have struggled, which is why ROEs have come down over time. About the management, I think, but it's one of the most spectacular management in this small cap kind of a space. They had done full family planning in 2015. Like, who does it when they are in their late 40s? Like, the guy running the show also has a lot of respect in the industry.
So I think I have seen very few managements which are doing M&A successfully, and Suprajit, as you know, some of the last, especially 2 M&As, were not that successful so far, but I'm willing to give them a sort of a longer rope, because what they have done with their previous sort of acquisition. But it remains to be seen. Let's see. So yeah, I struggle quite a lot while giving this presentation, because I was doing for the first time on this forum. But yeah, I'm sorry for that.
No, I think it was wonderful. I really enjoyed it.
It was wonderful, Omkar. Excellent.
Okay. So just one more point over here. So another advantage this product selection gives them, right? So is if you see the capex requirement for all their products, it's very less. I mean, I think RSCL Geartech with their size now, they are doing like talking about 100 crores capex a year. But Suprajit still does around what 60, 70 crores capex a year. So if you see the free cash flow generation, they have been very consistent in their free cash flow generation. And the reason for that is the kind of product selection they have. I think the capex requirement is very minimal for those kind of products. And that actually gives them sort of the, as you said, Harsh, the cash they generate from the core cable business is very high. And their organic capex, even today with their size, is around 50 odd crores for the cable business.
Hey, Omkar, I have one question. First of all, thanks for the nice presentation. I was doing some work on Suprajit around 2019, and they acquired some halogen producing lamps in Germany, correct? Like Trifar. So what happened to that? Did they able to integrate it well?
Yeah, okay. So just probably some context to this halogen lamp acquisition. So they acquired a company called Phoenix Lamps in 2016. Okay, and when they acquired that company, Phoenix Lamps, they had European subsidiaries, which is Trifar and Luxlight. So they are nothing but just a marketing arms. So they initially had a very small, very small manufacturing setup and warehouses. So when they acquired the company, they knew the terminal risk for the business possessed because of LED. But their game, so the game they are playing, or the strategy they were playing, was for this global aftermarket business. So I was reading somewhere the global aftermarket for halogen lamps is some 8 billion USD, and it's not yet decreasing market, because as and when till the time there are halogen sort of bulb cars, that market will keep on increasing. And then meanwhile, that gives them chance to see, I mean, definitely they must be already working on the LED or what needs to be done to avoid that terminal risk. But so the game they are playing is this global large giant aftermarket. So initially they thought these Trifar and Luxlight, which you are referring to, just give me a second, sorry, I'm started coughing. So Trifar Luxlight will be their European arms. So they did similarly in cable business. So they kept Suprajit Europe as their front end in Europe, and they kept manufacturing in India. Okay, give me a minute, sorry.
We can also stop. It's maybe we stop. It's okay. We can discuss it via chat.
Yeah, I think we should give him some break, because
no, it's fine. Okay. So yeah, quickly I'll finish this point and then we can stop. So Suprajit Europe was a front end for the cable, and Suprajit Automotive was back end in India. So they wanted a similar model in lamps business, where Trifar Luxlight will be a front end in Europe and the manufacturing will be based in India. But when they started sort of building on that model, they realized the costs in, I mean, this business, the aftermarket, or the aftermarket business, is very much cost sensitive. And because of this European operation, that is actually adding their costs. So rather than having this front end set up with 2 subsidiaries in Europe, now what they are trying to do is just have a direct export from India. So that's why, so they kind of, I mean, they took some write-off in one of those subsidiaries. They scaled down their operations. I think now it's with a bare minimum setup in Europe, and their sort of strategy is they will do sort of direct export of lamps from India to rest of the world.
I mean, just to mention, these Trifa lamps are pretty classic in Germany. I did some work asking my colleagues or went to some kind of an, like this outdoor houses, and it was there. I mean, even the older nameplates were there. I just wondered why they didn't scale it, because I think, if I remember out of my memory, around 17, 18, they had at least had 100 crore turnover, the Trifa ones.
Yeah.
Per year.
Yeah, and that has come down significantly now, if you see these years, because of multiple challenges they face.
Thanks a lot. That was great.
No problem.
Great work. Great work.
Thanks a lot, Omkar.
Thank you.